In this video, we're going to talk about options. Don't worry, this is a very beginner-friendly video. If you're new to my channel, my name is Vijay. I've been an options trader for over 7 years, and in these videos, I talk about passive options investing and active futures day trading to ultimately help you become a better trader. If you want to join me on this journey, hit that like button, smash the subscribe, and let's jump into the basics of options. All right, we are going to talk about options. So if you've never heard of options, this is a great introduction, I believe. If you guys have any questions throughout any of this, just leave a question in the comments below. I'll be happy to answer it. So let's talk about options. It is a financial contract. And I know that sounds super simple, but it really is. But what's important is what is inside this contract. And typically, when there are contracts, there are at least two parties. Of course, if you talk about brokers and all that, there is more than two parties, but we're only going to talk about the two parties right here. The two parties we're going to talk about are the buyer of the option and the seller of the option. Interestingly enough, you can actually decide to be either the buyer or a seller of the option based on the circumstance and the type of position you're willing to take in the market. For example, if you think the market wants to go up, you could buy some options. You could also sell options based on your opinion on the market. Similarly, if you think the market's going to go down, you could also buy an option or you could sell an option based on your opinion on the market. And here's something that's really interesting with options that most other asset classes don't have, is that you can actually bet on non-directional moves. So for example, if you think the market's going to stay flat or it's going to stay within a range, there's actually strategies for you to profit without any movement. And this is why options are so powerful, because they have so much versatility and you can do pretty much anything based on your opinions on the market. So we did talk about two different parties here, the buyer and seller. So let's jump into that. So we have the buyer and seller right here. Typically when you buy anything, right, you pay money, right? And when you sell something, you receive money. And that's exactly what it is in options as well. You can buy an option, and when you buy an option, you pay money, and this is known as a premium. And similarly, when you sell an option, you are receiving the premium. And this premium amount varies by a bunch of different factors. They're called the Greeks. That's outside the scope of this video, but I will make sure I make a video on that so you kind of understand how options are priced. If you want to make sure you don't miss that video, make sure you hit that subscribe button so you'll get notified when that video is out. So the buyer pays the premium and the seller receives the premium. But why should anyone just randomly pay premium, right? You got to get something in return. So what is the reason they're doing this? The reason is because this contract gives the buyer certain rights, and the person receiving the premium, they are actually accepting obligations. And again, to accept these obligations, they are receiving this premium. Let's talk about the two types of options. There's something known as a call option, and there's something known as a put option. And with both these options, you could actually choose to be a buyer or you could choose to be a seller. So there is this quadrant right here. You could buy a call option or you could sell a call option. You could either buy a put option or you could sell the put option. And so let's say you wanted to buy a call option. What does this even mean? All it means is that the call option buyer, they pay a premium to who? To the seller. And why did they do this? Because they get the right, and these are the rights I talked about earlier, to buy 100 shares at a certain price on or before a certain expiration date. And so what this means is they basically pay some amount of money to the person who wrote the option to them. And when they pay this money, they're basically buying the right to buy 100 shares at a certain price on or before the expiration date, which is in the future. All right, so let's look at a quick example. Let's say right now a stock is trading at $100. You are bullish on the stock, as in you think the price is going to go up. But you don't want to actually just go buy the stock at $100 because you think that, hey, it may actually go down. I'm not really sure, but you think that has a possibility to go up. And so what you could do is you could buy something known as a call option at, for example, $105 strike price expiring in, let's say, 60 days. All this means is if the stock goes above $105, you have the right to buy 100 shares at $105, and you could sell in the open market for whatever it is. Maybe it's trading at $120 in 60 days. And that is actually really powerful, right? I mean, you're paying a premium for this, a small amount of premium to the option seller. If you remember the option seller here, they are the ones receiving a premium. And I'm just using hypothetical numbers here, but you would pay, let's say, $1 for this right to buy 100 shares of this certain stock at $105 that expires in 60 days. And remember, right now the stock is only trading at $100. So all that means is if you think the price is going to go up, great, you have the right to buy it at $105. And you could sell it for $120 in the future if that's where price actually wants to go. Let's look at a different type of example to concrete this. Let's say there is this beautiful house right here. You know, I'm going to make it smile because I'm fun like that. It's a house, but he's smiling. Let's say I want to buy this house. I don't know if anyone's bought a house recently or if you've understood the process, but basically when you buy a house, you have to pay something called a due diligence fee, where you get to lock in that house. You basically control it for the next 45 days or 60 days or however long the due diligence period is. And at the end of it, if everything checks off, you can go ahead and could buy the house. Let's say there's bad plumbing or electrical issues or something bad is going on and you don't actually want to buy the house. You're not actually obligated to. All you do is you just end up losing the due diligence fee. Basically, the seller of the house gets to keep the due diligence fee. Now, that's the exact same thing that's happening here with these call options. Basically, if everything looks good with the house, you can move forward with it and you have the right to buy it in 60 days or even earlier if, you know, that's what you want to do. And the seller is legally obligated to sell you the house at the $105 or whichever price the strike price is on, the price that you agreed upon at the beginning of the contract. And remember, they accepted the due diligence fee and they're obligated to sell you the house. That's the same thing here. The seller is obligated to sell you the stock at $105 because he accepted the dollar premium to do so. Let's say again, in this example, there's plumbing issues or electrical issues with the house and you're like, I don't really want to go through with it. All you do is you lose the dollar premium you paid. And the analogy here, or the actual outcome, is prices trading below the $105. You would not exercise your option because you could just buy it in the open market for less than $105. So there's no reason for you to exercise the option at $105. And that's why the option basically expires worthless. And the seller, they have that house again because they never sold it. They can go back into the open market and they could sell the house again. They can collect another due diligence fee and they can continue doing this until the house gets sold, as in until the price goes above $105 of the stock. I know there are a bunch of arrows, but let's go back. This will all make sense. So that's where we looked at the call. This is a house example. You pay a due diligence fee to the seller, which is known as a premium. And with this premium, you have the right to buy the house at a certain price. And that's what this is. You have the right to buy 100 shares of the stock at a certain price. And the due diligence fee does have an expiration date. And so you have to decide to buy it before then. And same thing with options here. There is an expiration date. So anytime you see call option buyer, think about the house. That should be your first thing. It's like, hey, there's a house. I am buying the house. And that would help you basically understand what call options are. Now let's look at the seller. Basically, the seller would receive the premium, but then now they're obligated, not a right, but they're obligated to sell the house to you, basically sell the 100 shares at the pre-agreed price, and it could be on or before the expiration date. So just notice, remember, there's two sides of a transaction. There's a buyer and there's a seller. They're both extremely important because you can't have a buyer without a seller and you can't have a seller without a buyer. So they're both extremely important. And you can choose to be either a buyer or a seller based on market conditions and what your investment plans are. So that is a call option. Hopefully with this house example, this makes sense, and I think that would help cement things. Now let's look at the put option. The put option is actually the exact same thing as a call, except one word, and that will change the entire definition. So similarly, there is also a buyer and a seller of a put option, but the put option also pays a premium to the put option seller. And this is where everything changes between the call option and the put option. When they pay the premium, the put option buyer has a right to sell 100 shares, again, at a certain price, on or before an expiration date. So this word right here, sell versus buy, this is the word that changes everything between the call option versus put option. So the call option gives you the right to buy the house. The put option basically gives you the right to sell 100 shares. And we're going to look at a different example, not house, because it will make a lot more sense by using a different type of example. So here, remember, the put option gives you the right to sell a stock. So let's also look at this right here. Let's say a stock right now is trading at $100. You think it's going to go down. So what you could do is you could buy a put option at, let's say, a $95 strike price. And for this, you would have to pay a premium to the put seller. Now, the put seller accepts the premium, but now they are obligated to buy 100 shares from you at $95 on the expiration date. So I know you're probably really confused. It's like I'm already confused, and I promise it'll make sense, especially when I go through the analogy. So right now, stock is trading at $100. You think it's going to go down. So you buy put option at $95. Let's say in 60 days, the stock is trading at $90. Because you paid a premium to the put seller, you actually have the right to sell 100 shares at $95. So that means the price could be at $90 or even $70, and you still had the right to sell it at $95. Why? Because you paid a premium to the put seller. So let's look at an analogy, and this will all make sense. So what we're going to look at here is car insurance. I know the car is beautiful. You can thank me later. But basically think of insurance every time you think of the word put, because that will absolutely help you with understanding the definition, right? Think about every 6 months you pay a premium to the insurance company. If at the 6 months you don't crash your car, the insurance company basically keeps all your money, and you would basically just be out of your premium. But let's say you do crash your car. The insurance company is obligated buy your car from you. Why? Because you paid them all this premium. Now in this example, the insurance company is actually the put seller. The put buyer is the insurance buyer. So basically, if no crashes happen, the put buyer just continues losing money, right? They're just paying this premium over and over again because they're a good driver, they're not crashing, they continue paying this premium, and all this premium goes to the insurance company. Basically, if there is a car crash, the put buyer gets to make a claim and they get made whole again, minus the, deduction and all that, because the insurance company will buy the car from you because you paid them a premium to do so. So anytime you see the word put, think of car insurance. Now that's exactly what's happening here. Let's say right now a car is at $100, but you haven't crashed it. That's fine. You just end up paying premium every single month or however long the contract is until the stock actually goes down. So if the stock is above $95, that means there's no car crash, as in you're just going to continue paying this premium to the put seller, who is the insurance company. But the moment the price goes below $95, you could file for an insurance claim, and the put seller would just be obligated to buy the 100 shares from you at the predetermined price on or before the expiration date. And think about it. If the stock goes all the way down to 70 because you still paid the premium, the put seller is still obligated to buy the 100 shares at the 95 on the or before the expiration date, and they're obligated again because you paid them the insurance premiums, and that's all put options are. So here, the put option buyer pays a premium to the put option seller, and they are obligated to buy 100 shares, the contract is for, at the predetermined price on or before the expiration date. And so the best way to remember this is to think about a car. So call, think about a house. Put, think about a car. Now there's one more way to remember the difference. Now if you guys remember this back in the day, this is what phones used to look like. I guess I could have drawn an iPhone or something, but I'll draw an iPhone too, just because there's no buttons. It's like simple, and the dimensions are all kinds of messed up. This one's easier to draw, so I'll leave it like this. But anyways, these are phones. So the best way to remember for me the difference between a call and put is call up your friend, and then after the conversation, you put down your phone. So if you think the stock is going to go up, you would buy a call option. You call up your phone. If you think the stock is going to go down, you would put down your phone. Here is the biggest disclaimer of this entire video is just because you think the stock is going to go up does not mean you should actually buy a call option. And just because you think the stock is going to go down does not mean you would buy a put option. The whole point of this is to keep the difference between a call option and put option clear in your mind. So I cannot stress that enough. So remember, the call option gives you the right to buy 100 shares at a predetermined price on or before the expiration date. So because you think the stock's going to go up, you would use a call option, call up. Similarly, if you think the stock's going to go down, you would buy a put option. And this is from the buyer's perspective only. And this will help you keep the definitions clear in your mind. So going back to this is the basics of options. There's both a buyer and a seller for these transactions, and there's both a call option and a put option. And understanding this is absolutely fundamental to understanding more complex option strategies, which I will make sure I cover in this channel. So if you don't want to miss it, make sure you hit that subscribe button. Yeah, I hope you guys enjoyed this video. If you have any questions, just leave a question in the comments below. Or if you have any suggestions on videos that you'd like me to create or something you want a little bit more explanation on, please let me know in the comments below and I'll make sure I answer those. Also, we did put together a free email mini course, which goes over the basics of stock market investments and options to ultimately help you achieve financial independence. After you sign up for the free email mini course, make sure you check out this video.